Let's take a look at CART, which is something that Kiter wanted to talk about, which is a good idea. It's a market cap of 11 billion roughly. And in my book, that's a small cap. Now that we have $3 trillion market cap companies, what we used to call a small cap would be like under a billion. Well, geez, companies are so expensive now. I think 11 billion is a pretty small cap, but we'll see when they reset the definitions. The revenue is 3.21 billion, and their forward PE looks like they maybe didn't make a profit this year, 2024, is 40. Now, if they're growing, that PE is not bad. We'll take a look. And it's a buy rating according to analysts. I'm sure this is being evaluated by multiple analysts because this is a hot stock for the reasons being in the COVID years, consumer habits changed, right? We had to because we had social distancing. If you recall, the lines outside of Costco were like, really long. It took forever just to get in the store. Inventories were depleted. So it made it quite advantageous to go to Instacart and order your groceries. We did that. We continue to be customers. And their business model was proven out that, hey, that really worked. Now let's take a look at their revenues. So the revenues, wow, look at 2020, 590% growth. That is incredible. And they kept growing in 21. They grew in 22. They grew in 23. And then the trailing 12 months is at 10.69. Let me look at the quarterly. The most recent quarter that closed on June 30th, very solid growth at 15%. So when did they announce? They announced on November 12th. So not around the corner yet. All right. So we're going to have to wait a little while before their earnings are announced. And Kiter, you have a comment?
Yeah. One of the things that this company brought to my attention is that they are going strongly into advertisement. So clearly the delivery business is the same margin. It has a margin and they are profitable. I think that what I read that some of the numbers are impacted by the stock-based compensation that as an IPO company, it was or it is standing like heavy on their balance sheet. But this is kind of a one-time expense that impact the profitability. But to get to my point, what I read, and I also listened to their CEO with a strong French accent. I don't remember her name, and she's like pushing strongly toward the advertisement side of the business. And I'm not a customer, right? I'm not in the US. Maybe you do, and I saw that they are like, if you want to promote your product, it's a paid promotion, the same as like in Amazon or other companies. And this is the high margin side of the business that they are working strongly on building up and also implementing AI into this, into it. So they know what to, advertise you. So just as I don't know too much, but that's one of the points that I read about. Maybe we need some time in order to see it coming into fruition.
Yeah, I agree with everything you just said. And I was waiting for you to, finish your comment. I was going to say they're probably copying Amazon with the idea of the advertising. And it totally makes sense because as an Instacart user, I can tell you, you go in there and you're like, oh, I'm going to need laundry detergent. So you type in laundry detergent, right? Well, advertisers want to pay for it. When a consumer types in laundry detergent, I want you to put my ad there because that's perfect, placement. And Instacart saying, yeah, glad to, but we're going to charge you. And we're going to charge you a premium because that's a very desirable ad. So I totally get that. As they get greater scale, they're going to get greater advertising revenues. And Amazon does that quite well. All right. So it looks like they IPO'd in 23, which is one of the few IPOs. Holy smokes. We've had very few IPOs, but they're up 43%, which is very good. Usually I don't buy into IPOs because no matter which company you look at, even Meta, it went down like in the first year. So this one IPO'd, it's doing fairly well. This one may buck that trend. The revenues look good. They're growing nicely. And we'll look at their financials. We'll go to their investor site to see if we can get some more details. So it looks like top line, let's look at their gross margin. So see the gross margin here, 3.2 billion trailing 12 months. Gross profit, 2.4 billion. That's really good margin. So that's What is the margin rate there? That's 80% margins. That's very good. Now they've been building out their business, right? They have to compete against other, electronic competitors or commerce competitors, and they have to heavily advertise still. They're still doing R&D, making their platform better, and that's a good idea because you have to master the customer experience in order to grow. So these two things are, I'm going to call them somewhat temporary. Like Amazon, they were not profitable for the longest time because they just kept putting money back into their business, and they kept going up in market cap because the market understood that. If these guys continue to invest in their business, that's going to be okay. That's going to be okay because they're making themselves stronger, bigger, more competitive. Balance sheet wise, let's take a look at that. Cash, 1.4 billion, and long-term debt. Let's see here. Total debt, 32 million. No debt. They don't have any debt. Very good. Way to keep debt off your balance sheet. Are they cash flowing yet? Let's see. Operating cash flows there. Very good. So they're positive cash flow. Yeah, this one looks great. Look at this cash flow. It's those margins, 80% margins. Now you look at retailers, right? You look at Kroger's. Kroger's is like gross margins of 15%. But Instacart, which goes to a lot of Kroger's retail stores, picks up the stuff, delivers the groceries to the customer, they're at 80% margins. So most definitely this is far more lucrative, profitable, free cash flow generating. So I think this one's a good one to get our heads around, and I'll do an evaluation through the spreadsheets and stuff. So this is going to be a 623 million trailing 12 months cash flow. Okay. And
what about their share count, Victor? Do they dilute or do they hold the share count steady?
well, let's look at their investor site because I could show you the share count here. And this is probably going to be accurate, but you can really get the share count from their financials directly. So shares outstanding. So they were privately held, right? And then they went public. And since going public, their share counts dropped a little bit. But when you want to look at share counts, you look at their balance sheet that they put on their investor site, and you'll see exactly what's been happening there, if that's really critical to you. But it's a good move for it to be, shares being reduced to some extent. Okay. So I'm going to go to their investor site. So we would go to their investor relations, and I'm going to move this guy over here. And here is their investor relations. So they're going to report their third quarter on November 12th. They're a smaller company, so they're going to kind of be after all these big, massive companies report. Looks like Instacart. Okay, it's some headlines there. I'm not going to focus too much on that. Let's go into the earnings that they've already announced. So on August 9th, they announced Q2. I'm going to go straight to this. This is the 10Q. Every publicly traded company has to file a 10Q, a quarterly financials report, and it's going to include, all the latest things, and it's going to give us some, financial statements that I want to look at. So where's the income statement? I think I may have missed it. Let me go up a bit. Here we go. So here's the income statement, and here's the last 3 months for the second quarter of this year. And since it's the second quarter, they're also going to give us kind of like the year to date, the 6 months ended June 30th. Revenue. So this is 23 to 24. So we have an expanding business. Very good. An expanding business for the first 6 months. Again, cost of revenue. I'm really impressed that they have such high margins, gross margins. Now, I want to focus on a couple of things. So operating support, research and development, very good, making their business better, stronger. They're having to sell their solution. They're probably having to put some sales efforts into that advertising, business where they have to go to consumer packaged goods companies, food companies, and say, hey, don't you want to advertise on Instacart? And then general administrative. This really jumped up. I wonder what's going on there. All right. So in the quarter, They did turn a profit. Very good. So I guess last year they did not turn a profit, but now they're profitable and they're generating free cash. Very good. So here's a report, and Kiter, I think in the past we've talked about, share counts, and I think that's important to you. It's important to me too. The way I view when a company issues out shares to its employees, I treat that as a positive. If you make employees part owners in the business, they're going to work long hours. It's going to be everything to them, right? And I'd rather have employees at a company that feel that way as opposed to, you know, if they're just employees, they're just employees. If they're part owners, they're just going to really, really devote themselves. So I know some investors don't like when a company issues out stock to employees in the form of, share to its employees. But I don't treat it as a big negative. That's just my opinion on it. I think some investors don't like it. So here's the share count's been pretty darn stable. Not a big change. Good. All right. So I don't know what that is. I want to get the statement of cash flows and take a look at that. So here's the statement of cash flows. And these guys are following pretty much the format that most companies, typical companies, will follow, right? We have income statement, balance sheet. We know their balance sheet doesn't have a lot of debt, so I don't want to spend too much time there. But here we have the statement of cash flows. And this basically tells us, is the company generating cash out of their business? And it starts with their net income for the first 6 months. The statement of cash flows tend to be a year-to-date financial statement. So when we get to the third quarter being closed, it'll say 9 months ended June 30th. And we start with net income, and then you add non-cash items like depreciation's non-cash. Here's the stock-based compensation. And again, I don't view it as a negative. Some investors do, and it's how we look at businesses, and we can be different in the way that we have an opinion on a business. I think that's a positive, but some people don't believe so, and they actually reverse that number. But overall, they have $349 million of cash from operations. That's cash that the business is generating. It's almost like if you had a pizza shop, right? Hopefully everybody knows what a pizza shop looks like. End of the month, or let's say for the end of the first 6 months, you own this pizza shop. You spend all this stuff on flour and ingredients. You spent all this money on employees, and you paid your lease, all those good things. At the end, your pizza shop made $349 million. That's how much cash you have in front of you. Now, one thing we deduct is CapEx. So that same pizza shop, if all of a sudden you're like, hey, you know what? I actually had to buy a new oven for the pizza shop. Okay, I need to deduct that because that came out of my cash pile. I had to spend $38 million on a new pizza oven, which is going to reduce this number, 349 minus 38, excuse me, will leave us with 311 million. So that's 349 minus 38, 311 for the first 6 months. I mean, that coincides with their trailing 12-month free cash flow that we looked at earlier was 223. That's right on the button. If you double 311, you get 622. So we're right there. So that's a good number. All right. So now that we've seen, so just to kind of follow my logic, I like the business. They're in an expanding market. We're not doing less online. We're doing more. We have a business that's really focused on grocery. This is what they do. They will get groceries over to you. They keep investing in their website to make it even better, which I like, because I think they can quickly go to, recipes and stuff like, hey, what do I want to make for dinner? Oh, let's have Italian tonight. All right. So maybe Instacart can recommend a few recipes, and bingo, I can quickly get my bill of material from my local grocery store or from Instacart, and then have it delivered. I think that's good for the customer, and I think it'd be an area of innovation for them, as well as, just having standard orders, which I find convenient. You have your typical orders. It saves a lot of time when you have your template of what you order. You just check off the things you want, and then it gets delivered. So all those things are getting better for the business. I like the business qualitatively, right? Not looking at the numbers. Do I like the business? I do. Do I think the industry is expanding? I do believe the industry is expanding quite well. Are these guys investing in the future? Absolutely. So I'm liking the business. Do I like the numbers? I do. I like the numbers. So that's high level. That's first impression on the numbers. So let me crank into a value analysis, and we will take a look at, I'm going to compare them to Uber because I think that's a pretty good comparison. So here's my analysis on Uber. So I'm going to kind of copy that as a template, and then we'll do it from soup to nuts on it. One of the things that I'm really liking about our calls and live streams is you guys come up with really interesting companies, and then we analyze them. And I'm like, man, I wouldn't have looked at Instacart, but I'm glad you brought it up. What's their name? I think I'm waking up on a Sunday. I went to a good party yesterday. Maybe they can change their name because I'm like MapleBear, but that's just maybe.
So the explanation is that the founder was initially in Canada, and then he moved to your area. So the maple is from Canada, the bear is from California. So he called the company MapleBear. That's the story.
It's just not intuitive, right? It's not
No,
like
that's all.
Instacart is what I know. I've used it, many times. My wife, if you told her Instacart, she'd be like, "Oh yeah, I've been using Instacart for 4 years." And if I told her, "Hey, you familiar with MapleBear?" She'd be like, "No." Is that a new donut at the local donut shop? She wouldn't know that it's Instacart. So I think it's neat that they have that, originating name, and maybe it'll stick. But maybe they can. I don't know. Just my high level opinion. Maybe they can change the name. All right. So discount. I'm going to go to 9. Why? They're smaller than Uber, and it's a smaller company. I want a higher rate of return. They have an excellent balance sheet. Has nothing to do with balance sheet risk. It's just a smaller business. From a smaller business, I want a higher return because I am taking a higher risk. So, okay, so we went over cash flows, and we know that cash flows in the trailing 12 months are 623 million. Now, one thing I didn't look at very closely, but we can look at very quickly, and it's going to be hard, but let's take a look at it, is I want to kind of get a sense of, are they growing their free cash flows, and what's that growth rate look like? So they are growing cash flows now quite quickly, right? Because they went from 253 to 532 for the full year. And then if we look at the trailing 12 months at 623, so from 532 to 623 is roughly 91 million. And that's a pretty good clip of growth. That's like upwards of 20%. Oof, that's beautiful. And so I'm trying to determine what's the growth rate I want in my first 4 years of Instacart. I'm going to go with 15%, which is a aggressive but reasonable, given that these guys are growing and expanding their business. They are incredibly profitable. That gross margin number, that's why I like businesses like this, because when you have a gross profit of 80%, you see how much value comes down to the bottom for investors. Profit, free cash flow. All right, so we're at 623, and I'm going to do something. I'm going to go 623, and I expect that number is going to grow by 115%. Hopefully the formula is visible for you guys. And then the rest of the years are going to grow at 15% for years 2, 3, 4. So in 4 years from today, I expect this is going to be producing a little over $1 billion of free cash flow. And then I'm going to have a higher growth rate in long-term growth than, let's say, a traditional company. Like Kroger, I have this at 3%, very conservative. And this is a conservative number because they have a lot of addressable market. These guys could really become gigantic. But for now, let me go conservative. Okay. So 15% and 3 are my growth rates, 15% growing the numbers in the first 4 years, 5% being included in the terminal value calculation, which is all free cash flows past year 4. All those cash flows, this is like cash we're going to receive as investors, as part owners of this business in the future. Well, I want to discount it by a rate of return of 9%, a discount rate of 9% to get to a intrinsic value of 21.4 billion. They had how much cash? Let's go take a peek. So cash, 1.4 billion. That is good cash. And they had very little debt. So their debt was like 34 billion. 32 billion. 32 billion. That is excellent. So I add cash because they should get credit for, if I'm a part owner, I'm a part owner of this cash pile. And if I'm a part owner, I'm a part owner of their debt. So I add cash and take away debt. And their current market cap is not anywhere near that number. Their current market cap is 10.99 billion. And shares outstanding 257. So this is heavily discounted if you look at their free cash flows and how I expect their cash flows are going to grow. Now, why are cash flows that important to me, right? When we go and look at stocks, and we're going to look at so here are the mega cap stocks. And if I looked at Apple, very high free cash flow. NVIDIA, high growth with high cash flow. Microsoft, very free cash flow, very high cash flow, very high cash flow, very high cash flow. A very consistent norm is these companies become incredibly valuable when they can prove that they are free cash flow generating machines. So when we look at their free cash flow for Apple as an example, free cash flow, look at this cash flow. So they went from 51, 64, 59, 73, 92, 111, 99. And they do $104 billion of free cash flow. That's bigger than most large companies that are big. Like that's more free cash than Uber has in revenue per year. So there's a direct connection between free cash flow and an overall market cap and valuation of a company. And their ability to grow that free cash flow like Apple did in these years really makes the stock move. And it makes investors like Warren Buffett say, this is a very valuable business. And of course, his team did it years ago when it was a phenomenal investment. So that's why I believe that free cash flows communicate to me like the expected value of a company. And I'm looking for companies that is looking like this, where, hey, the value of the cash flows, they're going to keep loading up their balance sheet with cash. They're going to buy back shares. They're going to keep getting bigger. And an 80% margin business is really desirable because they can do a lot with 80% margins. All right. So analysts, 19 analysts cover the stock. That's a very, very good, number of analysts that are forming an opinion. They say, hey, we think the stock's just slightly discounted, and they are basing it mostly on earnings per share. 28 analysts are saying this is going to be their earnings per share in 2025. Since we are so close to 2025, we're like 2.5 months from the new year. And I'm going to use this number, $1.32 per share. And then I'm going to talk about my PE ratio. Their PE ratio is going to be, their forward P is 32. I'm probably going to go 36. I think 36 is reasonable. And that was 132 is the PE. Earnings per share, 36, growth rate, 30%. Now it's expected to grow 30% from 2025 to 2026. I never take the high, so I'm going to go 20%. So even based on earnings per share, using this calculation, Benjamin Graham's calculation, I get a 33% discount. I blend the two and I take a higher weight in free cash flow. This is a good stock. This is a good company. There's nothing that I'm gone over yet that makes me think this is they're going to have a big giant problem. I think the customer adoption may be a challenge. Like, where are they going to get their next wave of customers? Because they want to grow two ways. They want more customers, and they want to sell. They want those customers to buy more, right? Those are the two ways. And maybe they expand from, hey, we don't just deliver groceries. We'll deliver, fill in the box, other things, right? And maybe they get into commercial where businesses are like, hey, I'll use Instacart to fulfill all these things, but that might be stretching it. So far, so good. I like the company. I think it's discounted. And that's a good point to stop and see. You guys have questions? You guys have any different opinion or concern? Would love to hear that. Mr. Enkiter.
I have a question regarding the cash versus debt on the balance sheet. Isn't it typical for a young company that just did an IPO, to have like a large amount of cash because of the money that they received through the IPO?
Yeah. Yes. That's a factual statement.
So,
Yeah.
so in that case, wouldn't it be that the cash on the balance sheet is less impressive than seen, or or is it nonsense what I'm saying?
No, I think what you're saying is logical, and I think you're making a logical statement. They just IPO'd a year ago, so they should have, and we'll see that here. So that IPO is, I believe, when they sell shares, is it in? So there's three sections to a statement of cash flows. There's a statement of cash flow section that represents operations. You're operating Instacart. You're charging customers money. You're taking care of your expenses, and then at the end you have this cash left over. Then you have cash from investing. Okay, and this is where you do CapEx, capital expenditures, cash, investments in securities, that type of thing. And then you have a third thing is cash from financing. And right here, issuance of common stock. This is what you're talking about, right, Enkiter?
Yeah. Yes.
So we saw that in their IPO, they got $407 million from their IPO. Okay. So that balance sheet balance was actually 1.4 billion. So they, and let me go quarterly on that just to make sure that I'm seeing all the cash from that IPO that they got, which I'm pretty sure. So here it is. So the issuance of common stock, okay, and here it was, right? And look at this repurchase of common stock. Isn't that funny? They issued out and then they rebought. So that's interesting. They're repurchasing common stock at a very high rate. This is interesting. It's like you're a new company and you're already buying back all these shares.
Yeah, that's what I read as well. That they already have a $1 billion repurchase plan, which is active and is ongoing, and now the board approved another 500 million. So it sounds crazy.
So I don't like the idea. I'd rather that they grow their business. Hey, you're going to be really valuable if you go from being what's their revenue level? So right now you're a $3.2 billion company. If you grow to be a $30 billion company and stay anywhere near 80% margins, you're going to create so much value for investors. So if you need that cash, either now or in a year or in 2 years to grow, keep the cash. Don't buy shares. Just keep growing. That's where the value of the company will come from is, growing. And if you grow and you keep growing your free cash flows, the shareholders will benefit greatly. So keep doing that. I don't know why you would be buying back shares, but that's like a premium problem. That's like a high end problem. Like, oh man, this company's buying back shares. Well, that's a good thing. But in this case here, I'm like, well, I don't like it, but it's a high end problem. Yeah.
Can it be again? I have no clue. I'm just asking if there is some logic. Can it be that they have some commitment to their investors, like to return money quickly to investor that participated in the seed part of the company? The venture capitals and all
No.
these. No. Okay.
The venture capital, like whoever was an angel investor and venture capitalist, like or initial investor when they were private, they had their own shares, right? They were given before the company was public. They were giving a number of shares. So when they went public, you would see that, well, their shares were now more valuable, right? Maybe just to use an example, you'd have to study who invested in MapleBear, but maybe Andreessen Horowitz, which is a famous venture capitalist, invested 500 million, and they got like a lot of shares. Maybe their shares are now worth 3 billion because the company is worth 11 billion. Well, they made out really well. They invested 500 million, and now they're sitting on a $3 billion holding. That's a winner, right? So in situations like that, the shares are already out there. They're already issued out, and investors could get their money back by selling their shares. Now, is MapleBear buying back shares because they expect some of these big investors are going to sell their shares? Maybe that's a reason why they're buying back shares. I would just say that I see a lot of good stuff. If I'm going to point out to maybe some yellow flags or not even red flags, that's kind of unusual. Why are you buying back shares? You just IPO'd. If you didn't want to sell shares, why'd you IPO a year ago? But I don't think it's a big problem. I think it's a really interesting stock. I started this call by saying I'm finding it hard to find discounted companies in the United States. And guess what? Here's a discounted company in the United States. It's a small cap, and maybe big investors are all caught up with AI, and they're like neglecting this really neat little company here. I'm not. I think I'm gonna sit on it overnight, and I'm probably gonna buy some shares. I own Uber. I like these businesses.